Hey everybody, welcome back. We're on unit 6.4, which is effects of policies and economic conditions on the foreign exchange market. Now, in this first video, in this subsection, guys, we're going to be talking about the determinants of exchange rates. Now, what's an exchange rate? It's the rate at which we exchange one currency for another one. I like to call exchange rates the international price of a currency. Like we could talk about the price of a dollar. Now, when we talk about the price of a dollar, we're going to talk about it in terms of other currencies. So you'll hear the phrase, the euro price of a dollar. Now again, I'm talking about the price of a dollar, but now I'm talking about how many euros you need to get $1. Or we could talk, of course, about like the yen price of a dollar. How many yen do you need to get $1? These are the international prices of currencies, and right now what I'm talking about is the international price of a dollar in terms of some other currency out there. That's what exchange rates are, okay? The rate at which we exchange one currency for another. And in this video, we're going to talk about what determines these exchange rates. And to understand that, the most important thing you need to understand is that the exchange market, where exchange rates are set, are just means to an ends. The ends lie in the product market and financial market and resource markets of the domestic country and the countries abroad. In other words, again, the exchange market we just go to things like product markets, resource markets, and financial markets abroad. And exchange markets are what people from the rest of the world go to our product market, resource market, and financial market. Now, the way that I'm going to do this video here is I'm only going to mainly focus on the product market and the financial market that are in, of course, the domestic country and abroad. I'm going to ignore the resource market because it's just conceptually not that important for our major determinants. So, here's the deal. We're going to have 6 determinants we're going to go through. 3 of them we're going to associate with the product market, which means we're going to associate them with the current account. The other 3 we're going to associate with the financial market, which means we're going to associate with the financial account. And again, anytime I teach exchange markets or balance of payments, I like to integrate the two, okay? And you can already see I'm integrating our knowledge of balance of payments with exchange market. I think that's so important to do all the time. Okay, so let's just get to it. What are these determinants of exchange rates? What are these things that determine the international price of a currency? Well, number 1, and some people might call it the most important, is the relative taste for a country's goods and services, okay? Relative taste for a country's goods and services. Now, before I get going into this too far, I want you to understand this word relative is going to show up the whole way through. So everything that's happening here, we're talking about something is changing in one country relative to another, okay? That's so important to understand. Now, relative taste for goods and services. The thing I like to think about most with this one is when a country starts moving up the value chain of what they're producing. They're moving from, say, primary sector goods to being able to produce secondary sector goods or even tertiary. So what do I mean by that? Well, primary sector goods are commodities. Secondary sector goods are things that are manufacturing goods. We're moving into these tertiary sector goods. Those are things like information technology, okay, and services, professional services, okay? So as a country moves up the value chain of what they're producing, people are going to want more of their goods and services. And again, these goods and services are going to be more valuable, so they're going to need more of that country's currency, and so their currency is going to appreciate. That's the number 1 thing I like to associate with this one. But of course, that's not the only thing, okay? Sometimes you just get a question that's kind of like, hey, people want to go to Europe on vacation more, so there's an increase in desire to have for tourists to go to Europe. Well, that means we're going to go interact in Europe's product market. We're going to go to their hotels, their restaurants, their shops. And so what are we going to need? We're going to need the euro. And so, of course, the demand for the euro is going to cause the euro to appreciate. Okay? So again, relative taste for goods and services, very important. The next one, okay? Relative national incomes, okay? Relative national income. Now, let me first talk about, say, the U.S., their national income is going up. So when a country's national income is going up relative to other countries, what's going to happen to their currency? Ceteris paribus. And what's going to happen to their currency is it's going to depreciate. Why? Well, here's the deal. When your national income goes up, okay, just like when your personal income goes up, what do? You buy more stuff. And where do you buy more stuff? anywhere and everywhere. Yes, you buy more stuff domestically, but you also buy more stuff internationally. So when a country's national income goes up relative to other countries, hey, yeah, they're going to buy more of their own stuff, but important for exchange rates is they're going to buy more of other people's stuff. So that means they're going to supply their currency, and when they supply their currency here, their currency is going to depreciate. This is an increase in the supply of their currency, causing, again, their currency to depreciate. Now, also, for this one, sometimes you'll get questions about recessions, right? So a country falls into a recession. Well, what does that mean? They're going to buy less goods and services. Less goods and services domestically, absolutely, but also less goods and services from abroad. So what does that mean? They're going to supply less of their currency because they want to go abroad less. And since they're going to supply less of their currency is going to appreciate. That's right. Kind of weird, but you got to get used to that, okay? So they fall into a recession, a deeper recession than the rest of the world. That's, very important. So it's relative national income. They fall into a deeper recession than the rest of the world. Hey, they're going to want to go buy other people's stuff less than the rest of the world, if the rest of the world's falling into a recession too. But remember, they're going to a deeper one, so they're going to want to buy less of their stuff than, say, the rest of the world wants to buy less of their own stuff. And so their currency, again, is going to appreciate. Again, they're going to demand less of the foreign currency. Demanding less of the other foreign currency is going to cause that currency to depreciate. So, again, you got to keep your eye on this one. National income goes up, their currency depreciates. Their national income goes down relative to other countries, their currency appreciates. That's one that always kind of trips students up. Okay, number 3, all right? And here's, I got to say, I'm talking about nominal exchange rates in this video, okay? So this one is relative price levels. It doesn't change real exchange rates that much, but definitely nominal ones, and that's our focus in this video, okay? So, price level. When the price level goes up relative to other countries, so the price level here, again, product market. What is the price level? It's the weighted average of all prices of all final goods and services, right? So final goods and services, product market. So the price level goes up here relative to here. Well, given a current exchange rate, what would people do? They would want to go buy more products here, and these people would want to buy less products here. That's going to cause the domestic country's currency to depreciate because, again, their price level goes up. Hey, let's go there. And hey, these people want to come here less, demanding less of that domestic country's currency. Okay, so relative price levels. Price level goes up. Hey, that's inflation. And we can we already know the domestic purchasing power is going down. Well, guess what? The international purchasing power is going to go down also. Okay, so price level goes up. This one I think makes sense to most students. The currency is going to depreciate. Next. This one is super important for like AP and IB classes. It's the real interest rate, okay? So relative real interest rates. Now here is the first time that I get to kind of point back to my title of this subsection where it says effects of policies and economic conditions. We've talked about economic conditions, right? Recessions and moving up the value chain. But this one's our first one we get to really talk about policies, okay? So you want to keep your eye on monetary policy and fiscal policy. So expansionary monetary policy. What happens to interest rates? They go down. So we do expansionary monetary policy. The interest rate goes down there. Well, guess what? If the interest rate goes down there, I want to get my savings over here. And people who are savers that are over here are want to come here less. They're going to want to come here less. So again, if I want to go there more because the interest rate is down here, if I'm a saver, I like higher interest rates, I'm going to take my money here, means to an end. So I'm going to take my money here, I'm going to supply my domestic currency, my currency is going to depreciate, right? And of course, I'm going to demand the foreign currency is going to appreciate. So interest rates go down and the currency is going to depreciate. Now, if we do expansionary fiscal policy, that means we're going to run some deficits, right? We're going to do deficit spending, and when we run those deficits, that's going to put upward pressure on the real interest rate. So expansionary fiscal policy puts upward pressure on those interest rates, and guess what? The currency is going to appreciate, right? So here's the deal. We do expansionary fiscal policy, the interest rate appreciates. I'm going to want to go there less because, hey, I get higher interest rates here. I was taking some savings there, but I'm going to take less now. I'm going to keep my savings here. I'm going to supply less of my domestic currency. My domestic currency is going to appreciate. Savers here want to go and get that higher interest rate. So what are they going to do? They're going to go here and demand the domestic currency. The domestic currency, again, is going to appreciate. Interest rates go up. Domestic currency appreciates. All right? So that was that one. The next one. super important one, okay? I like to say 5 and number 1 are, like, to me, the most important ones in the real world. And here it comes. Expected future growth rate, okay? So expected future growth rate. So expected growth rate. Now, why am I putting this one, okay? Because growth, you think of growth as in producing more goods and services, right? Why am I putting this one with the financial market, right? With the financial market. Let me kind of pivot right here. Why am I putting this one with the financial market and the financial account? Mr. Blaine, growth, right? Growth has to do with goods and services. Well, here's the reason. Where do you want your wealth invested? I want my wealth invested in the country that's going to grow the most, right? Again, this is relative. I left out the word relative. Let's get that in there. So, relative expected growth rates. We start thinking the United States is going to grow faster than the rest of the world. We're going to want to keep our investment money right here, right? We're going to want to keep our savings here, and the rest of the world is also going to want to put their savings here, okay? Now, up there I said investment money, not a real economic way to say that. Remember, when we say the word investment, we're generally thinking of businesses spending money, so I wanted to change it over to saving. I think that's a little bit better, right? So U.S. savers want to put their money here because, hey, if we're going to grow faster, we're going to expect the expected real rate of return of our investments to grow faster here. And the rest of the world is going to want to get their savings here, okay? So, again, this is expected growth rate, and that's going to drive money to financial markets based on wherever the expected growth rate is the highest, okay? Again, means ends. Now, for that one, if we do expect the U.S. to grow faster, people want to get their savings into our financial markets, our currency is going to appreciate because they're going to have to go here and demand our currency. And again, American savers are going to stay here, so they're going to supply less of our currency. Both of those things cause the dollar to appreciate. Finally, relative political and economic stability, okay? So, relative political and economic stability. Now, for this one, okay, I also associate it with just expected exchange rate. So I don't have that on here, just the expected value of exchange rate, but I associate that a lot with 6 or just changes in 1 through 5. So I'm not putting that one specifically on here. But let's get to this one, relative political and economic stability. So here's the deal. Where do you want your wealth, okay? Your wealth is in financial markets, or a lot of your wealth is in financial markets. Where do you want your wealth? Well, you want it in a place that is economically and politically stable. So, if, say, the U.S. became less stable, what would people do? They would pull their wealth out of the U.S. financial markets. Both Americans would do that, and people who have their wealth in U.S. financial markets would pull their wealth out of those financial markets. And what would they do? They would take that to the exchange market, right? They would take it here, and so what are they taking here? Well, when they sold their financial assets here, they got dollars, of course, right? You need dollars to be in these financial markets. So they're liquidating their wealth, they're getting dollars, they're supplying dollars. Well, guess what? The dollar is going to depreciate. And then they're going to get their wealth into financial markets in the rest of the world. Anyhow, those are the 6 major determinants of exchange rates. I hope that made sense to you, and we'll see you in the next video.